want to do this presentation? Well, the obvious reason, well, maybe it's not obvious, but to me, it's been pretty obvious. Like I said, this really has felt like the first extended true volatility, time of volatility that I've really experienced. 2020, March of 2020 was quite volatile, but then it just rose up like a, comet to the sky. And so that bear market was so short that I personally, while it was quite intense, when I think back on it, it feels kind of like a blip looking back. And I'm not saying it was, but I'm saying that for me, this year, I'm really present to the volatility. And the second reason I want to give this presentation is I have a fascination with behavioral investing, behavioral psychology, and I really enjoy the topic and looking at how we can, as investors, can become better investors by having a healthy skepticism for our own brains and how we think and what we're motivated by. And some of the and how we can avoid some of the traps that can obviously hurt investors. And hopefully this presentation will contribute to your thoughts on that subject too. Okay, so quick plug or shout out to pexels.com. Maybe because my wife is a photographer, I'm very aware of appreciating photographs. I use some stock photography, and I want to thank Pexels, who lets you use them for free. And I think it's amazing, so I use some of that in this presentation. Thank you, Pexels. Okay, let me guess. Okay, today's expert advice comes from the following 3 books primarily that I actually will quote from. You'll see them. Maybe you've read these, maybe you read some of them. We've actually had J.L. Collins and Bernstein as guests in previous Bogleheads meetings. I had the privilege of interviewing J.L. Collins last year. It was great fun. I'm a real fan of his book. I'm also a huge fan of Bernstein. I honestly, interviewing him was challenging because he is so smart and he talks so fast, and it was hard to keep up with him. But reading his books, I have loved reading his books, and this book probably above all, The 4 Pillars of Investing. And then, of course, Your Money in Your Brain, which is a wonderful examination of the what he calls neuroeconomics or behavioral investing, behavioral psychology. And so again, something I'm a real fan of. And still, these are among my favorite finance books to date. Well, you'll be hearing from these folks. Thank you to them. They didn't realize they're a part of this. All right, so quickly, we're going to do a recap of 2022 volatility. This may not surprise you, but it'll help focus our presentation. So first off, being a little transparent here, this is actually from our personal capital dashboard, and it may look like yours. Maybe you have something similar, but you can see that this is going back to yesterday. You can see the volatility, the overall index, the portfolio has dipped, and in fact, those are the ETFs those represent. And then here are the results. U.S. stocks down 16%, actually 16.33% as of yesterday. International stocks down 13%, U.S. bonds down 10%. It's a double whammy or triple whammy, depending on how you look at it. Not only stocks down, but bonds are down, and I know that is very uncommon. In fact, all of my reading, I had never encountered this, and I know it goes back many decades since that's been true. But it, I guess, has happened before. And so anyway, I'm not telling you something you don't already know. I know you know this, but again, just for the sake of this presentation, we've had a volatile year so far. All right, so if it bleeds, and this is from headlines that actually were up this week. I don't know if you, like me, if you look at headlines, but I generally do like reading the business and investing articles. And here are some of the headlines we've had. Stocks drop amid concerns about economic slowdown. Americans lost $500 billion in wealth in early 2022. S&P 500 posts worst week since January after inflation hits 40-year high. Persistency of inflation could tip us into recession. All right, if that's not enough to activate your amygdala, I don't know what is. We'll be talking about that in just a moment. So that's the recap of the volatility of the year so far. Of course, And I feel I should say, as you probably all know, the media loves to dramatize the stock market and always does it. Always. As long as I've been following the investing stories, it's always dramatizing everything. So, however, it definitely is cascaded recently. They're having a field day with all those wonderful uh, uh, ways of catching people off guard and making them feel uncomfortable. So, but anyway, that's the recap. All right, we're going to go into the four-letter words. So the four-letter words that I chose for today. I was being kind of cheeky with this title, obviously, but I thought it'd be attention-getting. We're talking about fear and risk. Fear and risk. So let's quickly examine fear in red uppercase letters. All right, so we have this thing called the amygdala. And I'm going to have to move things for a second because this poll is making it hard for me to see it. So I'm going to go back. Okay, now we're good. The amygdala. This is from Wikipedia. The amygdala is one of two almond-shaped clusters of nuclei deep and medially within the temporal lobes of the brain's cerebrum, shown to perform a primary role in the processing of memory, decision-making, and emotional responses, including fear, anxiety, and aggression. The amygdalae are considered part of the limbic system. All right, that's a lot of science talk and medical talk that I am no expert in, but you know, it impresses upon us that this part of the brain, it has a really important role in our who we are, in our brain, in our functioning in life. And of course, the main thing I want to focus right now is on the fear and anxiety part, and as it relates to us as investors. And here's an excellent quote from Jason Zweig's book, which is where, you know, I got a lot of this information about the amygdala. Step near a snake, spot a spider, see a sharp object flying toward your face, and your amygdala will jolt you into jumping, ducking, or taking whatever evasive action to get you out of trouble. This same fear reaction is triggered by losing money or believing that you might. And I really emphasize that last part because I really see, and Zweig goes into this in the book a lot, how much we can spook ourselves by the anticipation of loss, and that the real thing itself may not be as bad. And maybe you know what I mean in life. When have we, you know, stressed ourselves out by anticipating something we don't want to have happen? And you go into it and maybe it's not as bad as we thought, or even if it happened as bad as we thought, maybe it didn't feel quite as bad. But that is what happens in our brains. So I think this is really important to set up the foundation for an empowering discussion about how we can handle ourselves through times of volatility, is by recognizing a sort of a predisposition to basically freak out. Okay, so yeah, and Zweig does, you know, says it in a very articulate way. Here, let me go on to the next one. Oh yeah, so the crash of 1987. This is a great story or example of the amygdala in action. It was exactly the kind of event that sparks the amygdala into flashing fear throughout every investor's brain. Okay, let me reemphasize. Every investor's brain. You know, I apologize. I need to make these. I got to simplify something, spotlight, and change things up so that I can see my own presentation better. Okay, this is better. So, every investor's brain and body, the memory was hard to erase. In 1988, US investors sold $15 billion more shares in stock mutual funds than they bought. Let's take that in for a minute. And their net purchases of stock funds did not recover to pre-crash levels until 1991. So I think I got muted somehow, and happily I'm back. So So let me rephrase what this is saying. The fear response is so powerful and so vivid. It can leave such a vivid impact on us that a vivid experience like the crash of 1987 spooked people for over 3 years, like collectively, and so that they hadn't returned to pre-crash levels until 3 years later. Now, this may not surprise you, or maybe you haven't heard this kind of thing, or maybe you've experienced it again in successive crashes we've had in periods of time where this happened. It's happened repeatedly since then. 9/11, the financial crisis, and even maybe to some degree the COVID crash. And perhaps even right now this could be happening. But it's wired into us, and that's the point I'm trying to make. The amygdala fear response is so wired into us, and it definitely impacts us as investors, especially if we don't find a way to defend ourselves from it. Okay. Oh, okay. Speaking of defending ourselves from it, this is from J.L. Collins. Fear is perfectly understandable. Nobody wants to lose money, but until you master it, such fear will be deadly to your wealth. It will prevent you from investing. Once you are invested, it will cause you to flee in panic for the exits every time the market drops, and drop repeatedly on its relentless march upward, it will. Now, before we go on, I do want to point out a few things. First of all, I realize this quote is quite strong, maybe a bit heavy-handed. I know we in this meeting tend to be very smart, educated as far as investing, and I would say this is less likely to be us, but believe me, we've encountered from time to time investors who I feel probably have been scared off by market drops and fled in panic. I've seen it, and even in our meetings occasionally. But even if that doesn't apply to you, this part about mastering our own minds, that's the part I'm most interested in, and that I hope that this presentation is going to be a part helpful in, maybe give you some idea or remind you of something you hadn't thought of or just needed to hear again. And also the other part of this quote that I really like is he says it will drop, the market will drop, but it will, and repeatedly so, but on its relentless march upward. And one thing I love about J.L. Collins is his positivity about the relentless march upward part. As long as you can hang on, you're going to have a good relentless march upward eventually. And I will touch on that more as we go, but I just wanted to point that out right now. All right, we're going to go on to risk, the other four-letter word, risk. Okay, what is risk? Well, we hear it all the time in our discussions, and everybody has a sense for what it means to them. But I figure Investopedia might be a good resource. Risk is defined in financial terms as the chance that an outcome or investment's actual gains will differ from an expected outcome or return. And then I purposely left out this second sentence. Risk includes the possibility of losing some or all of an investment, of an original investment. I know that's probably the crux of it all for us. What we think of as financial risk is, am I going to lose money, or am I going to lose all my investment? So thank you, Investopedia. Okay, risk is contagious, just like fear. The sense of risk. When an intangible feeling of risk fills the air, you can catch other people's emotions as easily as you can catch a cold. I think that this is really telling about the predisposition of us to kind of get caught up in the emotions of the moment, especially when it comes to investing. And I think it's very, says it very poignantly. So we're going to move, okay. So I think there's also this idea that we have as we read about investing, that we can just take a test or read about risk tolerance and discover what our risk tolerance is, and then make an asset allocation that is appropriate for that. But Zweig makes an excellent point by really asking us the question, is our risk tolerance really as simple and cut and dry as high or medium or low? Are we aggressive investors? Are we conservative investors? Or are we moderate investors? And he says, your attitude towards financial risks can differ dramatically depending on how the risks are framed, whether you are alone or in a group, how your previous bets paid off, how easy it is for you to think about the risk, what mood you are in, and even what the weather is like outside. So the main point I wanted to bring up here about risk is that I think it could be a bit of a misnomer to think that we have some kind of fixed risk tolerance. And he really is pointing that out. And I think that's one of the things that, again, is central to this presentation, is the idea of having a little skepticism about, a healthy skepticism about our own minds. We always want to continue looking at ourselves and our own experience through our careers as investors, because our willingness or ability to handle risk may change over time. And I'll be interested when we have our discussion to hear what you might have to say on that, because I'm sure that some of you who've been investing longer than I have might have a lot to offer there. Okay, we're going to move on to the 10 ways to stay the course through times of volatility. Again, this is my perspective, and I had to come up with 10 because I told Greg I was going to do 10 ways to stay the course. So, you know, and there's something I might have left out that might be really important to me, and there are possibly things that you may think are important to you. And again, when we discuss this, feel free to add them. But we're going to start with number 1. Oh, no, here's a quote. The best investors make a habit of putting procedures in place in advance that help inhibit the hot reactions of the emotional brain. All right? Now, if there's any one sentence that summarizes the thesis of this presentation, I would say it's this one, because this really is the key, I believe, to success through times of volatility and to navigate through the natural vicissitudes of our brains. So we're going to get into some specifics. Okay. Number 1 is focus on what you can control and know what you can't. Very important. We're going to start with the second part. Things you can't control. I think that this is I personally have thought a lot recently about this issue. What can I not control in life? And it's making me, I would say, a happier person, not only as an investor, but just as a person, to be aware that there's a lot I cannot control. So let's go into it. You can't control what will happen in the market. Surprise, surprise. What may be even more surprising is how often people think they can either control or maybe anticipate what will happen in the market. You know, the crystal ball fallacy. But you can't control what happened in the market. Can't control what others will do. You can't control whether the world is full of, if other investors are full of fear or greed. Where is that? What's going on in the moment? You can't control how they're going to react. You can't control what companies are going to do. You can't control, unless you're a CEO of one, and then you have influence over one company, and that's not the market. Anyway, you can't control mostly. What will happen? You can't control what will happen in the short run. We don't know what's going to happen next week, next month, or next year. We don't know what inflation will be. We don't know what economic growth will be. We don't know what the S&P 500 will be. We don't know if emerging markets will be great, the place to be in the next 6 months. We don't know if crypto will still be the it girl of the moment, or whether it will have faded into obscurity because it's seen as just a fad, that like the tulip mania that burst. Who knows? But we don't know, do we? And we obviously don't know what will happen in the long run. So basically, we can't control nearly everything. Sad face. And I think that it might seem like a simple point of view, but I think it's going to be so easy. And I've just learned this personally. It's going to be so easy to think that there are things we can control which we really can't. I mean, essentially, I think if people stress over things, maybe there's something that they can't control, but that we have this expectation as if we have some kind of control. So instead, let's focus on what we can control as investors. What can we control? Well, this is stuff we talk about day in and day out. You can buy low-cost index funds. You can control your costs, and you can buy the whole market instead of just buying one stock and hoping it goes up. You can bow out of having to guess what's going to happen and just own the whole market. You can control making regular deposits and automating it so that you don't have to think about it, so it happens automatically. You can control doing that. You can obviously control rebalancing and how you monitor the progress of your investments to make sure they're in accord with your asset allocation, which is the last part. You can control the risks you take. Okay, I just wanted to point this out, that asset allocation is really about risk management. Your asset allocation is a statement of the risks you're willing to take, and you can control them. And I think this could be very important for anybody who's concerned about risk. Now, once you're in it, if you're in the middle of this year and you've already made the asset allocation choices, well, you might have to learn to live with the risks that you've taken on, but you do have control over the risks you take. And I think a lot of investing management, personal finance management, comes down to making a decision about what risks you're willing to take. And so like I said, you can control it. All right, here, let's move on. Okay, so if you're doing your job right, in Bernstein's words, your superior portfolio strategy should be intrinsically boring. All right, it's not a huge point in this presentation, but I just like the quote a lot, and I want to point that out. And then J.L. Collins similarly says, letting an index work its magic over the years isn't very exciting. It is only very profitable. And I think that this also, 1 minute, I need some water. This goes into the thesis of how to create a structure or make decisions about your future as an investor and your approach and your strategy that will help you in the long run and that will mitigate the tendency to be emotional. And sometimes people like drama. Sometimes people like the emotion, or we think we do. When we like the movie, we like to see the movie. We like to take the scary ride at the amusement park. But do we really want our portfolio to be dramatic like that? Well, these folks are saying, no, you don't want that. You'll be more successful if it is boring, if it's not very exciting, and you can control that. I would say you can willingly be boring, and it'll probably help your portfolio in the long run. And it'll probably help with, sleep at night, the sleep at night factor, and dealing with risk and fear. Okay, we're going to move on here. Number 2 on our list of 10 ways to stay the course is to distinguish short-term versus long-term risk. And this I really I give credit to William Bernstein, who really is pointing this out in his book, The Four Pillars. And as he says, the intelligent investor knows that the visceral reaction to short-term losses is a profoundly destructive instinct. I think we all know that. We shouldn't, panic sell, everything just because it's gone down a few percent or something like that. I think that's what he's referring to here. So I wanted to point out what I came up with of some short-term risks, and Bernstein also writes about in his book. Uncertainty about where the market is heading. That's obviously a risk, and that's probably the one we're faced with day in and day out. The possibility of your portfolio going down. Losing money on paper, which means, or maybe it's on your computer screen. Usually that's where we're seeing it. It's on the computer screen, we've lost money. Short-term risk. It's the balance goes down. The possibility that an asset underperforms in the next year or two. What is underperformance? It's that it doesn't meet your expectation of performance. So in the short term, there's that possibility. I mean, even in the longer term, it could be longer than next year or two, but this is just an example. Obviously, and then finally, perhaps the most important for us investors is the possibility of stress, fear, or worry over our investments, or that sleeping at night factor, the possibility of sleepless nights, or just the anxiety of short-term risk. Okay. But the thing is to put risk in context of what risk really matters. Short-term versus long-term risk. And Jason Zweig says, every investor's worst nightmare is a stock market collapse like the crash of 1929, which would obviously be a very vivid, visceral, and ugly short-term risk for us to live through. Anything like that. But he says the real risk is not that the stock market will have a meltdown, but that inflation will raise your cost of living and erode your savings. Now, when I first read this, it was a few years ago, and inflation had been, under 3% for like 40 years or something. So I was, like, oh, that's interesting. I should take that seriously, but it's kind of conceptual. I know nowadays inflation is not conceptual, it's very real. So this quote certainly resonates for me and probably for you too. But again, this is about looking at two different types of risks, short-term and long-term. So long-term risks include, obviously, inflation, which can reduce the purchasing power of your portfolio when it's time to use it. Portfolio underperformance due to improper asset allocation. It's too risky or too conservative. Too many gambles or not enough. Behavioral mistakes that damage your investing performance, like you sell in a panic, or you're so afraid of short-term loss that you do something stupid and myopically, short-sighted about that to avoid loss. Obviously, the big one in personal finance is having enough money in retirement. And that's obviously, I think, probably the central focus of our planning is to make sure that doesn't happen. So anyway, but again, I felt this was a good distinction, something to keep in mind when you're navigating through the waters of investing, short-term versus long-term risk. Okay, if you can obtain high long-term returns, what does it matter if you have lost and regained 50 or 80% of your principal along the way? All right, I'm going to let that sink in for a moment. I know there's a lot there, and I'm going to read it again. If you can obtain high long-term returns, what does it matter if you have lost and regained 50 or 80% of your principal along the way? Well, one reason I love this quote, it really helps frame risk in the proper light. And also, of course, it's pretty dramatic normally to think of losing 50 to 80% of our portfolio value. Of course, he's referring to the 1929 stock market crash, but it did happen, and it could happen again. But if in the long run your returns are still high, what does it really matter? Now that, of course, assumes that you're able to navigate those waters without panicking. But I think he makes an excellent point. All right, get your risks straight. I love this little story, this anecdote. It's one of my favorite stories in his book. An investor places $10,000 in a mutual fund in the mid-1970s and then forgets about it. Shocked by the October 1987 market crash, she panics and calls the fund company to inquire about the state of her account. "I'm sorry, madam, but the value of your fund holdings has fallen to $179,623. So I think it kind of self-explanatory. It's a fun story, but it also shows the difference between panicking in the moment, which is a short-term risk, and doing the right things as an investor in the long run. The short-term risk really, in this case, is not a long-term risk. And depending on how you look at it, obviously this statement looks at it from a very positive way, and you can kind of laugh along. And hopefully we should all be so lucky. But I do think it starts with how we look at these things. And this is a great example. Okay, we're going to move on. So the thinking long-term, very, very important. Okay, we're going to do a little navigate through some graphs here. I was inspired by previous emails that Greg sent out to the Sacramento Bogleheads in previous times of volatility. So thank you, Greg, for inspiring this. So this is the S&P 500 to date as of a few days ago. As you can see, it's down quite a bit. And if you're like me and you've been spoiled by the 2010s almost constant rise up, you're thinking, are you kidding me? It's down 14%. Oh my God. So, but let's look a little bit longer term, okay? Let's go to a year performance. And then we see, oh, the S&P is down 2.5%. Okay, that's a lot better. I mean, meh, it's not great, but hey, that's a little better, right? But what if we back up even further, okay? Let's look at 5-year performance going back to 2017. Suddenly we got green. Okay, we're up 69.5%. That is a number that I think any investor could be inspired by, even with all of this dang volatility we're going through right now. And of course, that little thing in 2020, that dip in the middle when the world briefly seemed to be falling apart, and then we sort of found our way through it. Maybe not so briefly, but the stock market obviously seemed to be falling apart briefly. And then it rose up there, as you see. So, but let's go even further out. Okay, we're going to look out. Oh, yeah. Wow, that's positive. Okay, we're going to look out 40 years. 40 years. Now we got something truly exciting. I think this gets to the heart at why people are so enthusiastic about investing in the stock market. 40-year performance is up 3,605%. And if you're like me, where do I sign up? So again, what are we doing here? We're thinking long term. How can you reframe the moment? Go out, go like fly above it, go up as high as you can. So you're not just seeing all the details of the moment, and the picture starts looking a lot better. Okay, an example of this. In 1974, the Dow closed at 616. At the end of 2014, it was 17,823. Over the 40-year period, it grew with dividends reinvested at an annualized rate of 12%. If you had invested $1,000 and let it ride, it would have grown to almost 90,000 as 2015 dawned. Again, this is kind of like the Bernstein example, but it's then I guess a somewhat similar period, but going out even longer, and it speaks for itself. Okay, thinking long term is what we're all about, isn't it? I mean, that's what the Boglehead philosophy is, buy and hold is about. But sometimes, again, I put this here because I feel that sometimes we want a reminder. It's just good to get the reminder. I certainly appreciate it. I hope you do as well. And again, think long term. Okay, let's see. Okay, number 4. This is really a good one. And I found myself doing this in 2020, in March and April and May. Reframe risk as opportunity, because that's really what it is if you can look for it. So let me see here. Oh, great. So what if you could turn this into this? This is our little bear market, right? Of course. Okay. Or even better, what if you could turn that into this? All right, let's see how it's done. Because does it have to be scary? Well, maybe it could be a good thing for us. So Bernstein says the best possible time to invest is when the sky is black with clouds, because investors discount future stock income at a high rate. This produces low stock prices, which in turn beget high future returns. Now, if you're like me and you're still trying to figure out this discounting thing, I'm trying to understand it. I still don't fully understand it. But the main thing I would point to is low stock prices and high future returns. Because when everybody is pessimistic, or as Templeton said, the point of maximum pessimism, then stock prices are low. And that's a great time to buy. You've probably all heard it, but I just want to reiterate it here. And he says it very nicely. Okay, moving on. Okay, so you want to reframe how you see risk. So let's say that you got this asset that you bought. Let's say you already bought it. It's in that red dot. You bought it at that time and it was that price. Okay, so far so good, right? But then what happens? Inflation, problems, global uncertainty, and then the asset drops in price, but you're smart and you know how to see risk properly. So what do? I mean, you're already dollar cost averaging, so you're buying it at a discounted purchase. Maybe you buy more than you would because you can't because it's cheaper, and maybe you add a little extra because you see the opportunity. Okay, so now you're buying at a discount. That's not bad. I mean, even that could be kind of fun. I think. Oh, I got it cheap. I got it 10% off, 20% off. That's kind of where we're at now. All right, but let's say it drops further from that point. Okay, a lot of people are freaking out now. The pessimism is growing. You got a lower price, but you're smart. You know how to see this as an opportunity. So you make another discounted purchase. It's even cheaper. Now it's 30% down. Wow, that's actually good. I mean, if you went to the store and you got 30% off your favorite brands, you're excited. You're excited. You're not freaked out. You're excited. So let's say, okay, but the time happens. Wow, okay, we're really getting in the trough now. It drops even more, but you know the drill. You make another purchase. It's even cheaper, and you've got more of that fund or that asset. Okay, let's say at some point we know it's going to be the bottom. We don't know when it's going to be, but let's say this is the bottom, because if I went any further, I'd be going below that blue line, and we don't want that. But anyway, so from there, let's say obviously it's going to grow. It's going to grow at some point. Let's say we don't care the timeline. Eventually it's going to go up, and it's going to surpass its prior high, right? And at that point, what are you going to be saying? You're going to still be buying, and you're going to be really happy because at the new higher price, those discounted purchases really paid off, didn't they? Not to mention even the original asset price, which you thought was maybe already pretty expensive back in the beginning there. Everything is now appreciated, and nothing more than the lowest, the point of maximum pessimism, where you bought and continued buying. So again, I don't know if this is new for you to hear, but if it's something you haven't thought about before, or maybe you can incorporate this into your strategy. I found out during 2020 how I felt this way, and I was very excited to capitalize on it, and I was ready to buy extra in March and April and May of 2020, and I'm very glad I did. I also realized, okay, I think I can manage a bear market, and I'm very glad I did. But furthermore, I hope that talking about it here may help in some way for you. All right. Bernstein, a young person saving for retirement should get down on his knees and pray for a market crash. Let me say that again. A young person saving for retirement should get down on his knees and pray for a market crash so that he can purchase his nest egg at fire sale prices. That's exactly what I'm saying here. But I've never seen a more vivid way of putting it as this. Now, for just a moment, I do want to acknowledge that I know many of you are retired, or maybe you don't consider yourself a young person. You may have a smaller time horizon, and I do admit the limitations partly from my perspective. So if you'll pardon me on that, again, I invite you later. You might have a very different perspective, and even Bernstein does recognize that if you're retired, then a market crash is not so good for you. But again, I looked for solutions that will help me where I'm at. And I think as investors, we all do that. And you've probably looked for your own solutions. And what I like about this, whether or not it applies completely to your situation, is that it's a reframe. It's reframing risk into opportunity. And any way we can do that, I think, is a good thing for us as investors, no matter where we are in our investing journey. Okay. Number 5 is have a written plan, which I know most of you don't, based on the poll. But that's okay. Maybe it works for you not to have one. I found that it works for me. And, oh, there you go. That was me a few years back. So anyway, Zweig is really great about this. He says the best way to prevent yourself from being knocked off track by your emotions is to spell out your investing policies and procedures in advance in what's called an investment policy statement, or IPS. So yeah, again, as I said, I read his book and I proceeded to create an IPS for us, for my wife and myself, and we use it every year. I read it over to her. I make some adjustments early in the year, and it helps keep me on track. It keeps me accountable, and also it helps involve my wife in the process. So, what are some of the elements you might put into your investment policy statement or your investing plan? Well, regardless of whether you write it down or if you put it in an IPS, we all make these decisions, or should, what is your investment allocation strategy? What percentage of each type of asset are you going to be buying and are committed to buying and owning? What are your investment goals? Of course, your time horizon, your plans for the money. I found this very useful with the investment policy statement because I wrote it out. This is what this is for. This is how long this asset or fund or account is meant to be growing for. This is what we hope this will be, and I think that could be very useful to write out, and I found for us it is. What actions will you not take or will control carefully? So maybe you allocate some play money to go waste it all on Bitcoin. Sorry, that's my personal bias. Maybe you allocate some play money to put it on Bitcoin, or maybe you're buying stocks and that's okay. Maybe you control that. Maybe it's 5%, maybe a slightly more, but that's your play money, and then you're not concerned about what happens to it because you already allocated it. What actions will you control? Well, will you be buying individual stocks? You can kind of write this in if that's part of your game. How can you control that? What are you not going to let yourself do? You're not going to buy on a tip from your neighborhood barista. If they're saying, hey, we should buy Bitcoin, well, maybe that's not a sign that it's the best thing. Maybe could we say market crash or tulip mania? Tulip mania comes to mind when I hear about that stuff. But anyway, you can write in your policy statement actions you will not take, things you will not do. You will not respond to newsletters or like people hit tips from other people on YouTube ads saying, hey, you should buy this thing. And how often will you review your strategy? Annually is what we're doing, or maybe it's twice a year. Also, of course, rebalancing, that's a part of it. So anyway, again, I included this because if you haven't written out your plan, this could be useful. If you haven't read your plan in a while, this could be useful. If there's a question here that you haven't thought about, regardless of how you have your investing plan written or not, this could be useful. So I hope it is useful. Moving on, number 6 is accept the risks. Yeah, this guy does. And invest with your eyes open, or with a cute eyes on your hand thing. But I was obviously trying to be vivid and visual. So J.L. Collins, safety is a bit of an illusion. There is no risk-free investment. Once you begin to accumulate wealth, risk is a fact of life. You can't avoid it. You can only get to choose which kind of risk you take. If you invest in stocks, you'll likely outpace inflation and build wealth, but you'll have to endure a volatile ride. All right, let's see. Know the risks. Okay, I'm gonna lay out some stuff here. This is courtesy of Vanguard. The time frame is 1926 through 2019. Okay, so we're gonna look at some various allocations and how they performed. You may have seen this if you use Vanguard. They have this resource here, and my mouse keeps being weird, and I wish I were better at some things. Oh, that might help. Okay, and then, so, whoops. Operator error, bear with me. Okay, so the fixed income portfolio, as you see, 100% fixed income. I don't think anyone here, I'm assuming no one here is that, but you can see the results historically. And years with the loss, only 14, and worst year was down 8.13%. It's so far further down this year than 1969, but anyway, that was 2019. Okay, so then we get 50-50 equity and fixed income. the average annual return has grown, as you can see. And I'm sure, again, I'm sure you know this, but just to review, what we're looking at is the risk to reward ratio here. That's what this represents. Okay, and you should know your risks. Then when we allocate, we are choosing our risks, as I said before. So we do 70% equity. Obviously the average return goes up, but the worst year goes up a lot as well. And suddenly there are 23 out of 94 years with the loss. Finally, 100% equity. The average annual return is the highest on the list, but so is the worst year. And so are the number of years with the loss. Again, you may have seen these charts, but now think about your own portfolio as a set of choices about the risk you're going to take on, because that's exactly what this is saying and what you are choosing. And I think it's a beautiful thing. One of the biggest levers that we control as investors is how we allocate risk. Okay, so if you want to earn high returns, be prepared to suffer grievous losses from time to time. And if you want perfect safety, resign yourself to low returns. Thank you, Bernstein, for that vivid statement. Okay, moving on. You should keep your risk in perspective. I heard this very quote that I'm about to share, something like it, early on in the Bogleheads meeting, and it's still stuck with me. The market always recovers, always. And if someday it really doesn't, no investment will be safe, and none of this financial stuff will matter anyway. That might seem kind of dark, but let's put the fear of loss in perspective. Okay, it's a beautiful thing that we live in a country that has an operating economy and stock market that we can rely upon thus far, and that we have the privilege of talking about what our investments will do and whether they will go up and down and worrying about them and allocating accordingly. But it presupposes a functioning world that we live in, and we live in such a world, and we should ever be so lucky as being able to worry about our investments. I think that's one way to put it. Okay, 7, have a healthy skepticism towards yourself. Kind of introduced this a little while ago. Jason Zweig, over the years, I've grown convinced there are only 3 kinds of investors: those who think they are geniuses, those who think they are idiots, and those who aren't sure. As a general rule, the ones who aren't sure are the only ones who are right. Ways to keep yourself in check. All right, let's list these. I personally write about my investing choices quite a lot. I write in a log, I write on my journals, I like to write anyway. Why do I make the decisions I make? Zweig recommends that. Study your own investing behavior and watch out for cognitive biases or behavioral mistakes. What have you been prone to? Have you gotten swept up in the crowd? Did you freak out and panic and put your head under the rug or down, hide out? Or maybe you got overconfident or got influenced by recency to think that a stock that went up is always going to keep going up. Consult a trusted accountability partner before making portfolio changes. That could be a spouse, an advisor, a friend, family, or even a fellow Boglehead. Or obviously a lot of us like to go on the Bogleheads website, and that's what a lot of people are doing. They're checking out their choices and decisions and from other trusted sources to see what they think. Use your IPS to create a procedure you can follow before you make portfolio changes. Okay, we're going to move on. Behavioral mistakes to watch out for. Overconfidence, somewhat self-explanatory. If you think you can predict the market, if you think you know what's going to happen, if you think you know what a stock is going to do, it is possible you may be suffering from overconfidence. Recency bias is that you saw the stock go up, you saw Bitcoin go up to 60 grand, and you're sure it's going to go up to 120 grand. That's a problem when you project into the future what has happened recently in the past. Past performance is now no indication of future results. See, Gene, I worked that into this. Okay, availability bias. That is the bias of what comes to mind most easily. So everybody's talking Bitcoin. Everybody's talking Bitcoin. It must mean that Bitcoin is something I should buy because that's what everyone talks about. Or you're in US, so everybody talks US stocks, and that must be what I should buy because that's all I know is what is familiar to me. So then we don't make other choices that could be better investing choices. And then loss aversion. We kind of touched on that before. Being so focused on fear of loss that we lose perspective of the greater gains. Okay. You must recognize the counterproductive psychology that causes bad investment decisions such as panic selling and correct it in yourself. In doing so, your investments will be far simpler, your results far stronger. Or toughen up, cupcake, and cure your bad behavior. Thank you, J.L. Collins. And if you're unsure, err on the conservative side. Bernstein has this to say: thinking about the possibility of losing 30% of your capital is like training for an aircraft crash landing in a simulator. The real thing is a good deal more unpleasant. Do you want to learn what your actual asset allocation is by going through a crash landing? Err on this conservative side if you're unsure. Okay, we're going to go forward. Just say no. Embrace these don'ts. Okay. Controlling your behavior is as important as what you do is what you don't do. In other words, don'ts number 1 and 2. Don't look, especially if you are easily spooked. A lot of people talk about this. Don't look at your portfolio every day or every week or every month. If the news is bad, don't look. You'll be less likely to make mistakes. The studies have shown that the most successful investors, it's funny, there's a study that showed that the most successful investors were the ones who were dead. And I think it's funny, but really the ones that had their accounts who never looked. Or maybe, let's prefer living investors who are alive but just don't look. The second one is don't need to know. And I give this credit to Jason Zweig, who said, to succeed as an investor, you don't have to outsmart Wall Street. You buy an index fund, and then you can say, I don't know what's going to happen, and I don't care. I don't know, and I don't care. Don't number 3 is don't just do something. Sit there. French philosopher Blaise Pascal hit the heart of the truth when he wrote, all the misfortunes of men come from only one thing, not knowing how to remain at rest in a room. I think it's very, very profound to this discussion is how we can just not make bad decisions. Or as Buffett said, I figured we've got to have at least one quote from Warren Buffett. You get very rich if you thought of yourself as having a card with only 20 punches in a lifetime, and every financial decision used up one punch. Take that in. You only had 20 punches in a lifetime. He calls it the law of inertia. You'd resist the temptation to dabble. You'd make more good decisions, and you'd make more big decisions. Now, I kind of take the essence of this, the idea of less is more. Do less. Stick with your plan. Buy and hold. It's not timing the market. It's time in the market. That's where I go. So, in other words, don't just do something. Sit there. And most of all, don't panic. And, don't be this guy. Let's stay put, folks. Let's not bail. Let's not try to eject. Let's stick it out. We'll find a way. All right, moving forward. Number 9, keep learning and share what you know. This is partly something I wanted to put in because this pertains to my own philosophy and what I like to do. I love to learn and I love to teach. So how to continue your financial education is keep reading, keep listening to podcasts, participate in these meetings. And of course, investing is the best teacher because you'll learn from experience. And I wanted to put up again our expert advice. In case you haven't read these, I highly recommend them. Happy to tell you them again if you need to, or you could take them down if you're curious about any of these. Great writers, brilliant thinkers. Okay, and how to share your investing ideas and strategies. Okay, you could start an investing themed blog. I actually did start a blog. It's a personal blog, not just investing themed, but I found it was great to write about my thoughts on investing, and it has helped me articulate them. You can discuss investing with interested, that's the most important word on this sentence, interested family and friends, people who are interested, because otherwise it may not go so well. And then lastly, you could give a Bogleheads presentation like I'm doing and learning a lot by sharing my strategies and helping myself focus, because after all, learning and teaching others are great ways to gain new skills, articulate what matters to you, and maintain your focus on the big picture. And that was said by me just now. You heard it, right? Okay, so number 10. Whoops, what's going on? Number 10, where is it? Oh, there it is. Okay. All right, let's see what's going on next. Oh, wow. Interesting. Oh, yeah, that's true. Yum. Oh, enjoy the ride. Okay, I see where he's going here. Don't sweat the small stuff. Take it easy. Enjoy some German food. Right, Greg? Enjoy Germany. Find things to appreciate. Look at the bright side. In other words, live your life. I think that's one of the most important things. One of the reasons that the investors who don't look are probably the happiest, because they're not obsessing over the small stuff of the ups and downs of short-term risk. Instead, let's enjoy some ice cream. Today's a good day for it here in Sacramento. I believe it. Believe me. All right, and on that note, we're going to have something fun. This is actually, that you can see Mr. Charlie Chaplin, and it's actually a YouTube video that I actually created recently. I wrote some music and put it up to this little excerpt. So we're going to listen to it. I'm hoping that space bar starts it off here. Whoops, that's not it. See, you can see this is my final. There you go. Whoops. All right. Thank you. That has been my presentation.